Hello, welcome to Financial Accounting course and Accounting Equation. As I mentioned, we're going to do a case study, and this is about a a business called AAA, and it's a merchandise company. And I prepared this case study. It's a generic, but it applies to real life. And let's let's begin this. Let me introduce you this accounting equation. So you remember I said basically the accounting equation is the assets equals liabilities plus owner's equity. And then these are the breakdown of liability. These are the breakdown of owner's equity, and these are the breakdown of assets. And again, I want to reiterate that what we are talking about is quite basics. If we only talk about assets, we're going to have really long discussions what assets are, but this is what we start. So the other point that I should point out is that whatever amount we have here should equal here, and otherwise we have something wrong in our calculations. So let's begin so that you see. I made here 12 transactions, and then each transaction has a date. And then as we go through, we will put those. And transaction number one, it says on January 1st, let's put January 1st, the company, who is run by Mr. ABC, invests $25,000 in cash in the new business. So let's say $25,000. We add $25,000 in the cash here. It's assets. As we see here, the balance changes to $25,000. So now, where we record this, the $25,000. So it's under the owner's equity, specifically the owner's capital. So we add $25,000 here. So as soon as we add here, we see that $25,000 under the owner's equity, and that adds the total of liabilities and owner's equity, $25,000. Both side is equal. And then transaction number two, we have on January 4th, after an important meeting, they make some investment. Sorry, this is supposed to go here. January 4th. After some important meeting, they make some investment decisions, and then the business called AAA purchases equipment in cash. So now we have to reduce cash by $6,800. And then because we are buying equipment, we are adding cash by $6,800. So remember, sometimes a change in one side of the equation will be a change on the other side, but it's not always true. If both assets are both asset classifications are in the same, then the other side doesn't have to change, like this example. So we spent cash, we purchased equipment. They are both under the assets classification. So I just wanted to point out. And transaction number three, on January 11th, we see that AAA purchases supplies on credit. That means it purchases supplies, but it doesn't pay it in cash. So that means we add $2,200. I'm reading from the case study. Whatever is written here, I'd reflect it here, just to make sure that I reference it. And those who are beginners, I don't want them to get frustrated. I want to make sure that they understand every single thing. And that's the purpose. The simplicity is the language that we use here. And they purchase supplies with $2,200, but they are paying, it's basically a liability. Remember, we add to supplies, we also increase liabilities. If you see that we added $2,200 here, our total on the balance side is now $27,200, and now on this side is $25,000. And then where we add here our liabilities, it's the account payable. So we add $2,200 here. So now the both sides of the equations are the same. On transaction number 4, so I'm reading again from here. Transaction number 4, transaction number 5, and then the dates. January 15th, AAA, which is the merchandise company, makes a sales in cash. So, okay, we are having cash. How much is it? $5,500. Since it's a revenues, we are making sales, we are adding it in the revenue column. $5,500. So we see that both sides of the equations are the same. $32,700, $32,700. Transaction number 5. On January 18, AAA spent on advertisement for $580. Maybe the company sees that, okay, I opened a business, I'm not making sales, let me spend some money on advertisement. But let's see if it pays in cash or credit. As we see here, it says to spend advertisement on credit. As soon as you see on credit, that means it's not paid in cash, it's liability. So and just to note that advertisement in accounting is considered expenses. So we add our liabilities by $580, which is accounts payable, and we deduct this amount by $580. And again, minus $580 doesn't mean that their expense is reduced. In fact, in this equation, we put minus 580. And as we see again, both sides of the equation are the same, assets and liabilities. Transaction number 5. On January 20th, AAA makes a sales for $10,000. Okay, I'm glad after spending on advertisement, the company is now making money. Okay, what is the sales? It's on credit. Okay, it's making money, but it's on credit. So that means it's accounts receivable. So whatever we sell, but not in cash, but we expect to receive it in the future, it should come under accounts receivable, $10,000. And then since it's a revenue, it goes under revenue. So we see $42,700 on the both sides of the equation. And then we also have the breakdown, the sum of each accounts, cash, accounts receivable, supplies, equipment, separately. And then on transaction number 7, on January 28, AAA makes a sales for $25,000, and whereas $5,000 is in cash and $20,000 on credit. Okay, so basically we make a sale, but $5,000 is in cash. So we put it in cash, our cash increased, and then $20,000 is accounts receivable. That means we sold it and we expect to get paid in the future. So we put $20,000 under accounts receivable. And now what are we going to put on this side? So on this side, since it's a sale, we are putting it under the revenue, $25,000. So now we see that our revenues increased by 40,500, and then both sides of the equation is the same. If they're not matching, then you have a problem. That means your calculation is not right. And transaction number 8. On January 22, AAA pays its liabilities for $1,500. Okay, that means it reduces our cash by 1,500, and it also reduces our liabilities. You remember we borrowed these money, 2,000 here, 2,200 here, and 550 here, and then we are reducing our liabilities. And then again 1,500 minus 1,500. So we see that both sides of the equations are the same. Each time when you make a transaction, you have to make sure that both sides are the same. It's easy to track rather than, this is my tip, and rather than, looking at it at later stage, then you have to look at where exactly you made the error. Of course, this is also something that we're going to do in the next levels. Transaction number 9, let me go a bit up. Transaction number 9, it's on January 23. So receives payment for its accounts receivable for $5,000. You remember we made some sales, but we were not paid. So we receive now $5,000 in cash. So since we receive $5,000, and then our accounts receivable is also reduced by the same amount. So again, you see, we received $5,000 in cash, and then we deducted or reduced our accounts receivable. We didn't have to do anything on this side of the equation. And again, our balance is the same on the both sides, 66,200 on the both sides. Transaction number 10. I'm sorry if you see that I'm overemphasizing. The purpose is that I want to make sure that I can explain it properly or you understand it correctly, and that's the purpose. Transaction number 10. January 24th, AAA pays for its rent for $700, salary here, I'm reading here, salary for $1,200, and then utilities $180. So our cash is reduced by $700, $1,200, and $180, which is a total of $2,080. So since we are at beginner level, I just want to make sure you understand it correctly. In a higher level, normally we have separate accounts for all of these. Since now we are at beginner level, we put all of these under expenses, but we should be putting it separately. So minus $700 minus $1,200 minus $180. So now we see both sides of the equation, they are the same. Transaction number 11. On January 25th, AAA receives accounts receivable for $5,000. That's good news. So we have good customers, so they are paying on time, which is good, which is not the case most of the time. So $5,000 we received in cash, so we should also be reducing accounts receivable by the same amount, $5,000. Again, our both sides of the equation is the same. And this is the last transaction, which is 12. And on January 31st, the owner of the AAA withdraws to $2,800 here. So we are reducing cash by $2,800, and then we are recording owner's drawing. That means whatever the owner withdraws, we record it there, but we recorded by the same amount. So this is the summary of the accounting equation, and we see here that our total cash in our business is $32,200, $320. Our total accounts receivable are $20,000. Our total supplies is $2,200. The total equipment is $6,000. So this mix is $61,320. And on this side of the equation, we still have some liabilities at the amount of $1,280. Owner's capital, $25,000. The owner's withdrawal is $2,800. And the revenues, total revenues for the month was $40,500. And then the total expenses, $2,660. That makes the total liabilities and owner equity of $61,320. So I hope you enjoyed it and you understood it. And if you have any questions, or if you also not only questions, or if you like it, please provide your comments so that I understand how to make my next videos. And we are all improving and we need feedback, and I want to make sure that the people who are watching it, they are not wasting their time. I want to make sure that they understand it. Thank you, and see you in the next video.